Hi everyone, Iftekhar here from CLiK Trading Education, and welcome to this week's market roundup for the week ending the 7th of August. There's quite a bit to get through this week. We've seen US stock markets pushing to record highs, a big move in technology, gold absolutely flying, and then on Friday we got a US jobs number that really changed the conversation around interest rates. And actually, Friday was probably the best example of something we talk about all the time in our training. The number itself isn't always the most important thing. It's how that number compares with what the market was expecting. Because the US actually lost 23,000 jobs in July. You'd be forgiven for looking at that and thinking, well, surely that's bad for the stock market. Yet the S&P 500 went up. The Nasdaq went up even more. So why? That's what we're going to unpack this week. Let's start with the numbers because it was a pretty strong week for equities. The S&P 500 gained 3.58%. The Dow was up 2.96%, and technology really led the way, with the Nasdaq Composite gaining 5.19%. Europe joined in as well, with the Stoxx Europe 600 up around 2%. Then you've got gold, which had a very strong week. Crude oil moved the other way, and volatility eventually came back down as the week progressed. So was it risk on? Broadly, yes, but there's a bit more to it than simply saying investors suddenly became more confident. A big part of what happened was that the market started to reassess the likelihood of the Federal Reserve raising interest rates again. And that reassessment became much more significant on Friday. What's interesting is that the week didn't start with particularly weak US data. Quite the opposite. Manufacturing came in strongly. The ISM manufacturing PMI jumped to 55.6, up from 53.3. New orders improved, employment moved back into expansion, but prices paid were still very high at 71.1. Then we got the services data, again reasonably strong. The services PMI came in at 54.1. But look underneath the headline and you start to see something interesting. Prices paid were above 70, but employment dropped to 47.4. So you've got this slightly awkward situation. Parts of the economy are holding up reasonably well. Inflation pressures haven't disappeared. But employment is beginning to look less convincing. And that meant everybody was waiting for Friday's jobs report. And then we got it. The market was expecting the US economy to add somewhere around 80,000 jobs in July. Instead, it lost 23,000. That's a pretty sizable miss. And previous months were revised lower as well. Now here's the interesting bit. You might expect the stock market to look at that and sell off. It didn't. The S&P 500 gained 0.62% on Friday, and the Nasdaq rose 1.30%. Why? Because traders immediately started thinking about the Federal Reserve. Before the jobs report, there was still a reasonable possibility that persistent inflation could force the Fed into another rate increase. After the report, those expectations dropped. The probability being attached to a September increase fell to around 44%, compared with roughly 67% just a week earlier. And this is where you've got to separate the economy from the market. The market wasn't saying, fantastic, people are losing their jobs. Obviously not. It was saying, if the labour market is weakening, how likely is the Fed to raise rates now? Completely different question, and that's why understanding expectations is so important. Now, I don't want to make it sound as though the entire equity rally came from one jobs report, because it didn't. Earnings were strong as well. By Friday morning, 436 companies in the S&P 500 had reported, and just over 85% had beaten expectations. That's a strong earnings season, and technology and AI-related companies were right at the center of it. One company that really stood out was Palantir. They raised their full-year revenue forecast, US government revenue increased 90% in the second quarter, and the shares initially jumped about 14% after the announcement. Across our weekly data, Palantir went from roughly $126 at Monday's open to around $172 by Friday's close. That's a huge move. But here's where you've got to be careful as a trader. You see something move like that and immediately think, I've missed it. And that's when FOMO starts kicking in. A company producing fantastic results doesn't automatically mean that buying it after a massive move gives you a fantastic trade. They're two completely different things. Coming back to the broader market, the S&P 500 finished the week up 3.58%, closing Friday at 7,757.64. And think about what the market absorbed during the week. We've still got inflation concerns. We've got geopolitical uncertainty. We've now got weaker employment. And despite all of that, the S&P finished at record levels. That's telling you something about expectations and sentiment. And it's another reminder not to fall into the trap of thinking bad economic news equals stock market down. It doesn't work like that. You need to know what the market was expecting before the number arrived. Then we've got the Nasdaq. This was the standout amongst the major US indices, gaining 5.19% for the week. Technology and semiconductors were obviously a big part of that. But there's another reason the interest rate story matters, particularly for the Nasdaq. Growth stocks tend to be more sensitive to bond yields. So when expectations for higher interest rates start to ease, that can make those longer duration growth companies relatively more attractive. Again, this is why we shouldn't just look at an index and say, Nasdaq up 5%, brilliant. Ask what's underneath it. Which sectors are driving it? Is it broad participation, or is a relatively small group of large technology companies doing most of the heavy lifting? That gives you much more information than the headline percentage. Now, gold. This was probably one of the most interesting markets of the entire week. After Friday's jobs number, spot gold jumped around 2.3%, having been more than 3% higher at one point during the session. Across the week, gold gained more than 7%, and US gold futures finished Friday at $4,399.70. And the relationship here is worth understanding. Weak employment data comes out, the market reduces the probability of another Fed rate increase, bond yields and the dollar come under pressure, and gold becomes relatively more attractive. So if you're trading gold, don't just sit there watching a 5-minute gold chart. What's the dollar doing? What's happening with yields? What's changed with interest rate expectations? You don't need to trade all of those markets, but understanding them can give you context for the market that you are trading. Silver came along for the ride as well. Our futures data show it opening the week around $58.65 and finishing Friday around $63.50 after trading as high as roughly $65.48. Now, anyone who's traded silver knows it can have a bit more attitude than gold. It can move very quickly, and although gold and silver are obviously related, they're not identical markets. Silver has that industrial component as well. So if you're trading both, don't automatically assume the same position size or the same risk characteristics apply. If silver is moving twice as aggressively, your risk needs to reflect that. Oil gave us a completely different picture. WTI traded as high as $82.33 during the week, before finishing Friday at 78.18. Geopolitics remained a major influence, particularly around Iran and the Strait of Hormuz. But as the week developed, signs of possible progress towards an agreement helped take some of the pressure out of oil. And I think the diagram on this slide is actually really useful, because oil doesn't just affect oil traders. Think about the chain. You've got geopolitical risk affecting oil prices. Oil feeds into inflation. Inflation influences bond yields. Bond yields influence expectations for interest rates, and interest rates feed through into currencies and equities. So something happening thousands of miles away in the Strait of Hormuz can eventually have an impact on the Nasdaq. That's why understanding the bigger picture matters. Then we've got volatility. VIX futures started the week around 16, spiked above 18, and finished Friday down around 14.90. So despite some genuine uncertainty during the week, fear came back out of the market fairly quickly. Equities were rising and volatility was falling. That's generally consistent with improving risk appetite. But don't make the mistake of thinking low VIX equals no risk. We've got CPI coming next week, we've got PPI, we've got UK GDP, we've got US retail sales, and geopolitical risk hasn't suddenly disappeared. So this isn't the time to become casual about risk just because volatility has come down. This week's presentation doesn't contain our normal charts, so I'm deliberately not going to give you supply and demand levels that aren't actually in front of us. But we can still talk about the process. We've just seen enormous moves in the Nasdaq. Gold has moved substantially, silver has moved, individual stocks like Palantir have exploded higher. And that's exactly when traders start getting tempted. It's going without me. I've missed it. I'll just get in now. We've all seen it. But stop for a second. The question isn't what's gone up the most. The question is, where is price? Where are we on the higher time frame curve? What's the intermediate trend? Where's supply? Where's demand? Where's the opposing zone? And most importantly, is there actually enough profit margin left in the trade? Because if price has already travelled a huge distance from demand and is approaching supply, the fact that everybody on social media is suddenly talking about it doesn't improve your entry. Sometimes you've missed the trade. That's fine. There'll be another one. If I had to boil the whole week down into 3 lessons, these would be mine. First, bad news can produce a positive market reaction. The US lost 23,000 jobs. The S&P finished at record highs. That makes no sense if you're only looking at the headline. It makes much more sense once you understand expectations. Second, exactly the same principle applies to earnings. A company doesn't go up simply because it made money. It goes up or down according to how the results compare with what investors had already priced in. And third, you don't have to trade every big move. This is probably the most important one. Watching something run without you is frustrating, but you haven't lost money because you didn't take the trade. You can lose money very quickly if you chase it because you're annoyed that you missed it. There's a massive difference. Right, let's turn our attention to next week. And inflation comes straight back into focus. Wednesday, the 12th of August, US CPI. This is probably the biggest scheduled event of the week. And because Friday's employment report has just reduced expectations for another Fed rate increase, CPI becomes even more interesting. If inflation comes in stronger than expected, does the market start pricing a September rate increase back in? If inflation is softer, does that reinforce the move we've just seen? We don't know, and we don't need to guess. What we need to know is when the announcement is coming and which markets are likely to react. US indices, the dollar, gold, treasury yields, and the major dollar pairs are all worth watching. Thursday gives us another busy day. We've got US producer prices. And remember, we've already seen prices paid readings above 70 in both the manufacturing and services surveys. So this gives us another piece of the inflation puzzle. Then, here in the UK, we've got second quarter GDP. The Bank of England has held bank rates at 3.75%, so traders will be looking at how the UK economy is coping alongside those continuing inflation pressures. If you're trading sterling, the FTSE or UK markets generally, Thursday is definitely one to have marked in the calendar. And then on Friday, we've got US retail sales, another interesting one following the employment numbers. If the labour market is weakening, are consumers beginning to pull back as well? Or is spending still holding up? And again, there isn't a simple, Strong number equals bullish, weak number equals bearish. A strong number might be positive for growth, but if it increases inflation concerns and pushes rate expectations higher, other markets could see it very differently. That's the bit we need to think about. So what am I watching? I've got the S&P 500 and Nasdaq because we're sitting around record territory and we've got CPI coming. I've got gold because after a move of this size, I want to see what happens next. Does it consolidate? Does it retrace? Does new demand form? I'm not interested in chasing it just because it's had a great week. Dollar yen is another interesting one because you've got the interest rate differential story and intervention concerns. And finally, crude oil. That's still heavily exposed to Iran and the Strait of Hormuz, so headline risk remains significant. But with oil in particular, don't just watch the news, watch how price responds to the news. Sometimes a market refusing to rally on supposedly bullish news tells you far more than the headline itself. So that's it for this week's Roundup. And actually, I think this has been a really useful week from an educational point of view. We had strong manufacturing, we had inflation concerns, we had very strong earnings, we had geopolitical uncertainty, then we had a surprisingly weak US jobs report, and after all of that, US equities finished at record highs. That's markets for you, and it's why I'm not particularly interested in trying to predict every move. I'd rather prepare, know where my levels are, know where my supply and demand zones are, know what news is coming, know how much I'm prepared to risk, and then wait for the market to give me something that actually fits the plan. Because ultimately, one trade doesn't matter, one mistrade doesn't matter, one losing trade doesn't matter. What matters is whether you're still following the same disciplined process over the next 50 or 100 trades. That's trading, preparation rather than prediction, process rather than emotion, and always manage the risk. Thanks very much for watching. I'm Iftekhar from CLiK Trading. If you've enjoyed the Roundup, give the video a like and subscribe to the channel. And stick something in the comments as well. What are you watching next week? Are you watching gold after that huge move? The Nasdaq around the highs? Or are you waiting for CPI before doing anything? I'd be interested to hear what you've got on your watch list. Have a great weekend, have a good trading week, and I'll see you in the next one.